And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Well, it's 6:06 on this Thursday. As we're in this, and as we determined last week, this is the second best day of the week.
Yes.
Because it's pre-Friday, right?
Yes.
So, last week I was saying that Thursday was the best day of the week because it was, the day before Friday. But Brent corrected me. Friday is the best day of the week. So,
yes.
Second best day of the week, Thursday.
And it's the best weekend of the year. We get to turn the clocks back.
You get that hour back.
Yes.
Well, see, isn't this great? We're going to get two things out of the way. One, we'll get our hour back of sleep.
Yeah.
And two, we can get this freaking election over.
Amen.
So, there we go. So, yeah, this is going to be a great weekend. So just enjoy it. And a little cold snap coming in down here in Texas anyway. It's freezing up north, but there you go. So a couple of things, very importantly here, of course, yes, everybody wants to know what the hell happened yesterday, right? I mean, everything's been fine up to this point, and yesterday just kind of the wheels came off the cart. The S&P down nearly 3% yesterday. That's actually a little bit more, almost 3.5% yesterday, actually. Just a big decline yesterday, and this is really, while the sell-off was bigger than expected yesterday, this still, again, as we've been talking about here repeatedly over the last couple of weeks in particular, is that ever since we've had this money flow sell signal in place, we said that this suggested that we were going to get weaker asset prices as we head into the election. And that is exactly what's been occurring. And we had talked about just even yesterday that, this downtrend channel that existed, the market had maintained itself very orderly within that downtrend here over the course of the last couple of weeks. And so there hasn't been a lot of concern here, right? It's just been a very orderly sell-off. Well, yesterday, a little bit of a different story here as the market did break very important support. We crashed through that 50-day moving average. We broke support from these early October lows. And so once we really kind of got through 3,400 on the S&P, that was really kind of that moment to where the algorithms and traders just went bleh. And just kind of, hit the punch button to sell everything. And again, if you take really kind of a look across the board, it wasn't just the S&P that was selling off yesterday. Bonds also took a big hit yesterday. And this was interesting because bonds have been rallying here over the last couple of weeks, ran right to the 200-day moving average, resistance level, sold off yesterday, even though despite the fact that usually they act as a safe haven during a big decline. That didn't occur yesterday. But importantly, though, we are triggering a money flow buy signal on bonds. So kind of watch bonds here. They've been turning up nicely here, providing some support for portfolios. Not so much yesterday as yesterday was really kind of a liquidation sell. Really across markets. And I'll show you what I mean here, because if you've been kind of riding the small cap train, we've been warning about this for the last couple of weeks at RIA, on our subscriber service, riapro.net, talking to subscribers saying, hey, watch this small cap trade. It's under a lot of pressure. And so yesterday, big decline in kind of the small cap space. That really came along because the dollar had a very sharp rally yesterday. And this is one of the things that we've also been discussing repeatedly, is watching this dollar kind of base here, and that the dollar had been extremely weak in a very one-sided trade. And we were likely to see this dollar rally, and that occurred. And of course, when the dollar rally, that takes a lot of steam out of the international markets in particular. And we saw that impact, big decline yesterday in emerging markets, as well as kind of international stocks as well, also taking a fairly big decline. The kind of more mature in international stock markets, Europe, France, in general, Britain, the kind of the big industrial internationals, they took the much bigger hit here yesterday because particularly as COVID cases are kicking up there, we're seeing France lock back down, etc. So a lot of pressure, particularly international space. But again, this is also a reflection of that strength in the dollar. So money flows are now coming back into the dollar. They're also going, and as they come back into the dollar as a reserve currency, that's going to find their way into treasuries, which is going to help support treasury bond prices here in the short term. And so bonds will probably still provide a hedge to portfolios to some degree, although while they were down a little bit yesterday, not a whole lot. So they still help mitigate some of the downside risk in markets. But even gold prices, you would have thought yesterday that with kind of this big sell-off, that gold might get a little bit of support. Nope, didn't happen. And after running right in the 50-day moving average, we saw a drop pretty much in gold yesterday. Really, and again, this is the problem yesterday for a lot of investors, is it didn't matter what you owned, and it didn't matter what stocks you owned, and it really didn't matter if you owned hedges. Nothing worked yesterday. That happens in the market sometimes. That's just part of the investing game, and sometimes it doesn't matter what you own. Just nothing seems to work, and yesterday was one of those days. But again, here over the next couple of days in particular, that we're into the last couple of days here, right? So we've got today, tomorrow, Monday, Tuesday's election day. So again, the markets are really, this sell-off yesterday in particular is really just this repositioning of risk going into the election. Polls are tightening up. This is really down to a two-state race, Pennsylvania and Nevada. And if Trump can win Pennsylvania and Nevada, and polls are tightening up in Pennsylvania, Trump is gaining a lot of ground in Pennsylvania here over the last week in particular. But if he can win Pennsylvania and Nevada, he can still lose a couple of other toss-up states and still get the necessary 270 electoral votes to win the election. So again, as we saw this yesterday, this is really kind of what the markets are coming down to at this point, is really just starting to measure the risk of a potential election. And more importantly, for the market standpoint, we talked about this in our Candid Coffee this weekend, Policy Over Politics, which is on the website right now. I actually posted the video on the website at realinvestmentadvice.com, so you can watch the whole thing. But historically speaking, markets are weak just prior to Election Day. Now, after Election Day, we tend to get a much better turn in the markets. And again, watching our money flow sell signal here on the S&P, we're seeing that starting to bottom out here. It's getting pretty oversold. We're getting oversold conditions on the markets. We've wrung out a lot of the short-term overbought that was existing in the market. A lot of that's gone here. So we've reduced a lot of the risk, all very much in line with what happens in September and October prior to an election. After the election, once we kind of know what's going on with the president, etc., tend to get a better performance out of the markets in the rest of November and December. And again, that is all suggesting, though, that we don't have a contested election. So the contested election risk is that we do have further downside, and right now that is about another 6% between where we are now and really kind of previous support levels here at the 200-day moving average. So there is more downside risk. So don't forget that is still there. And if we do get into a contested election, if this electoral college is extremely close, if the mail-in ballots are delayed, there's a lot of things. There's already a lot of lawsuits piling up potentially to contest the election. And if we do get in that contested election phase, there is more downside risk. So don't completely dismiss that possibility. Statistically speaking, though, we tend to perform better. And again, if we go back to our money flow sell signal here, as you see, we're back to lows where normally markets find bottoms in the short term. So again, don't overreact to yesterday's sell-off. And again, when you have big weekly drawdowns like we had this week, typically the following week tends to give you a little bit better opportunity to reduce risk. We've been talking about reducing risk now for 2 weeks. So again, you'll have an opportunity here over the next week to raise some more cash and hedge portfolios a little bit more. So again, pay attention to what's going on, but don't overreact. What happened yesterday is already in the books. We can't do anything about it. So don't overreact to yesterday's action and just take action as we get into next week in particular. I'm your host, Lance Roberts. We'll come back. We're going to pick up with Michael Lebowitz, CFA, to talk a little bit about a very interesting story. A lot of people don't remember the Hunt brothers, but we're going to talk a little bit about what the Hunt brothers can teach us about markets and how they act today. Be right back.
And the way you look
Got questions for Lance later? Ask now at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark, mommy shark, daddy shark.
And welcome back to the show this morning. It's 6:19 on this second best day of the week, Thursday. Picking up with Mike Lebowitz, CFA, to talk a little bit about an interesting story. You know, a lot of people, and now I remember this particularly growing up because I remember my parents, you know, selling my grandmother's silver and those type of things. But people don't, a lot of people don't know the story of the Hunt brothers, Bunker Hunt in particular, who tried to corner the silver market. And, you know, why are we talking about this is because there's a lot of similarities between what happened to the Hunt brothers when they tried to corner the silver market and what happens in markets today more and more because of options trading, et cetera. So, but, you know, when you go back and read the story of the Hunt brothers, you know, they were trying to corner the silver market. They thought they could get it. They could buy enough silver to basically own the market. And they actually got the price of silver up to $50. But what's interesting is silver is in everything, right? And I mean, and we started seeing people back then as prices got higher and higher, they were scraping the back off the. And a lot of people don't remember this. They either used to take a picture with a Polaroid camera and it would spit a picture out, and then you'd wave it in the air for about 5 minutes until the picture emerged. Well, on the back of that Polaroid film was silver nitrate. So people were actually scraping the back off of Polaroid film. They were selling their mother's silver. They were taking the silver out of their teeth. I mean, at $50 an ounce, you know, it was very lucrative to sell silver. Well, what the Hunt brothers never counted on was all this other silver that was out there coming into the market. I mean, try to imagine trying to corner the copper market, right? Everybody starts stripping down, you know, houses to steal all the copper out of the houses, right? So, you know, price always incents people to take action when you get to a certain level, either high or low, right? But again, that's what the Hunt brothers found out. Anyway, I'm kind of stealing the thunder from Mike. Mike, good morning. Welcome to the show.
Good morning. Good morning.
So yeah, you know, the story of the Hunt brothers is you know, really fascinating, and unfortunately didn't work out well for them, you know, through this whole process.
Right. Well, I see. So I think there's another angle to the story too. So if you go back to this, all happened in 1979, 1980 when silver hit $50 an ounce, but it started $1.50 back in the early 70s. And the Hunt brothers were billionaires. Their father had started businesses in oil and sugar, real estate, all kinds of things, and they were very concerned at the time about, get this, fiscal deficits. and monetary policy.
Right.
Little did they know they had, you know, they don't even know, you know, it was just an ant on a you know, huge hill that was to grow. But anyway, they were very concerned and they wanted to hedge. Back then, you were not allowed to own gold. During the Great Depression, they stripped the ability of citizens to own gold. So next best thing was silver. And they said, okay, we'll buy some silver to hedge against the dollar, because all our assets are based in dollars, and that's our risk, so we're going to hedge. And this didn't start out as a manipulation scheme. This was just, we have to protect ourselves with insurance. So they started buying silver, and at some point they realized that every time they bought silver, the price of silver went up. The demand was outpacing supply. What they also realized was you could buy silver bars and have them delivered to your, you know, to your vault, to wherever you
to your garage.
I was going to say basement, but They can have silver physically delivered, but they said, you know what? If we go in the futures market, we can basically own the silver, not really own it, but have the rights to the silver in the future and do it on margin. In other words, pay 5 or 10% of the price, but basically control that much silver. And that's what they did. And they started buying more and more and more. And next thing you know, the price of silver is going through the 20s, 30s, 40s. It's up near $50 an ounce. And here's, like, Lance, I agree with you that a lot of silver came out onto the market through, individuals and through professionals that had silver in various ways. And you also had miners were more incented to mine for silver too, so there was probably a pickup in production as well. But here's where the Hunt brothers really lost. They went up against the establishment, the banks, those that were shorting the silver to sell to them. And that's the banks, the Federal Reserve, the exchanges. They're the ones that were on the hook for the Hunt brothers. They were basically helping, in a losing effort to their own profits, helping the Hunt brothers, and they had to put an end to this. So what you're saying is, in this particular case, this is also like the old story where it says if you owe the bank $100 or $100,000, that's your problem. If you owe them $1 million, that's their problem. And in this case, this was a bank problem, not the Hunt brothers problem. This was becoming a bank problem, and they were losing on that. They were on the other side of the trade for the most part. And the COMEX exchange was very worried that they would default, and there would be a massive default on their exchange, which then they are on the hook for, which, is a big problem too. So they decided to raise margins. At the same time, Greenspan, the Fed chair, was also raising rates aggressively, which made margin more expensive. Right. But they raised the cost of margin. So if they had to put up 10% to buy an ounce of silver, now they had to put up 20%. But they had to put up 20% on all the silver they owned already. And the Hunts didn't have that kind of money. And next thing you know, the price of silver is down to $15-20 an ounce a few months later. The Hunts ultimately filed for bankruptcy, and the banks, the establishment, won once again. Yeah. So the reason we picked that story is because it's somewhat similar to what's going on with these, what we call gamma squeezes today. And that's where these big investors buy a lot of stocks, and then they use options, which are essentially, it's a form of margin. It's a way to own a stock, but with a fraction of the cost. So you can buy options at, a few dollars. You can buy options on Apple, which is trading for over $100, right? And you can buy options for a couple bucks and control. You buy one option and control 100 shares, and it costs you, at $3 would be $300. So you can play the same game. You buy the options, and who's going to sell you the option? It's the banks and brokers and dealers, right? So they're on the other end of that trade, and it was probably costing them money to be on the other end of this trade. And what the lesson of the story is: don't go up against the banks. Right. Well, we saw this happen with SoftBank here recently. SoftBank was taking out huge option bets. This was in the run-up between August and September, as the markets were kind of running up. We were seeing SoftBank taking out huge call options on stocks in that run-up. And of course, when it got really kind of out of the advantage of the banks, we started seeing that process reverse, and it's been unwinding really for the last 4 weeks, and we're seeing that continue to unwind. Yesterday, really kind of when yesterday's market broke below 3,400. That was kind of the defining moment there, to where all of a sudden the algorithms and everything else kind of kicked in into sell mode, and is requiring the liquidation of those options. Right. So it's interesting. On a day like yesterday, the market was down a lot. You see a lot of narratives in the media, right? They're down because there's no stimulus. They're down because of the election. And that's true, right? The investors are taking risk off the table in front of the election. But what you don't see are these massive trades that go on. And this is potentially one of them. That the dealers, because the market's going down, the dealers may be pushing it down further because it really kills SoftBank or whoever these other gamma players are, and it forces them ultimately to sell the positions, and when those positions are sold, the underlying stocks get sold. So it's a double whammy for someone like SoftBank, and it's really hurting them.
And that's why you see the market. The market's been fairly constrained here over the last few weeks. It's been a very orderly decline, and then yesterday kind of the wheels just came off the cart, and that was where all of a sudden when you hit that moment and that forced liquidation occurs, then all of a sudden you see assets, and again, it wasn't just the stock market. It was gold, it was bonds, it was every asset, international, emerging markets, every asset was liquidated to meet those calls yesterday and that's why you had such a big decline in one day and really across all asset classes. And that's something it happens, and it's going to happen a whole lot more in this market over time. Investors need to get used to higher levels of volatility, get used to having days like yesterday, because we've got so much of our market now driven through algorithms and robotic trading programs, and more importantly, as you've talked about before, these passive indexes, which now outnumber the number of stocks that they're actually buying to build the ETFs with. When those all get liquidated, it just accelerates the liquidation across the markets. Quick break. We're going to come back with Michael Lebowitz, CFA. And we're going to talk a little bit about the markets here and where we are and what happens next. Don't go away.
I'm gonna hit you too. Another one bites the dust. Stop.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Show at 6:33 as we get this second best day of the week underway. Michael Lebowitz, CFA, joining me this morning on the Real Investment Show. Quick question coming in on YouTube, on our YouTube channel. Mike, I'm just going to give this to you for a second, let you answer this. How do you usually approach trimming the portfolio? Is it a percentage or some metric that you use?
We kind of do both, right? Here's an example. About 2 weeks ago, we were running pretty close to our maximum amount of equities. And we decided there's a lot going on in the markets. The markets in general, short-term technically, were overvalued. They still could have risen more. There was still some upside. But the downside was greater than the upside technically. And then, of course, you have the election. You have this stimulus, up in the air. So it seemed to us that there were more risks than rewards. So we decided that we were going to take it down by about 10%. And that's what we did, 10% as a percentage of what we owned in equities. And we did that carefully, right? There were a couple of days we took 1% down at a time. We didn't rush it. We kind of got ahead of it a little bit. I mean, we got a little bit lucky on this one. The market was kind of falling in a general lower trend the whole time. Mm-hmm. And about a week ago, we took off some of that exposure and got to where we wanted to be. We also, it's not just about equities, but it's about bonds too. And when we took off equities, we said we don't need as much of a hedge. And we also are concerned that if there's one of the outcomes is a potential Biden win in a Democratic sweep of Congress, right? Mm-hmm. And if that happens, there's a massive stimulus bill coming down the pike. And with that, bond yields are going to shoot higher. So that is one of the options on the table, and we decided to reduce some of our long duration bond exposure, which is those are the bonds that will move the greatest as the yields change. So each, there is no answer. Each situation calls for something different. And we may not be done reducing exposure. We have a lot of technical levels in mind here. The market, we're fortunate now because there's a lot of technical levels such as the 20-day, the 50-day, the 100-day, the 200-day moving average, old trend lines, the high from from last February. So we use all those as benchmarks, and when we are comfortable that we have gone through those benchmarks and that they no longer provide support, we will decide to reduce our exposure even further. So right now we're looking at the 200-day moving average, which is still 100 plus points lower than where we're at. And there's a few other lines in between that are guiding us through what's going to be a very volatile and tumultuous period, at least. And the problem is we can't say after the election this gets better. We don't know what's going to happen Tuesday night. This could be a month-long, 2-month-long problem.
Yeah. And again, we talk about this every week in our weekly newsletter. So if you go to our website, realinvestmentadvice.com, click on the newsletter link, for the last 3 weeks, we've been talking every week about, hey, there's excess risk here. We're raising cash or reducing exposure. This is where we're taking money off the table of. And again, as Mike said, there's no exact answer. It's not to go in and you sell half of everything you own or 5%. It's simply looking at how much risk you're taking and versus and really looking at how your portfolio is performing relative to the markets and saying, hey, look, if the market goes down 3%, I don't want to be down more than half of that. And so you reduce and rebalance the risk in your portfolio till you start getting. It's kind of like a recipe for a cake. You just kind of keep tweaking the ingredients of your portfolio until you get the beta, which is its relative performance to the index, in line with where you're comfortable. And again, so the point is not trying to avoid all downside. That requires you to sell everything. And then the problem is you don't get back in when you need to because you're worried you're still going to go down some more. It's about just mitigating risk and adjusting exposures relative to how much volatility you're comfortable with. And for everybody, it's different. I mean, some people, they don't care that the market went down 3% yesterday. They're fine with it. And that's okay. If they're very aggressive, they're completely good with it. I'm not good with that. So Mike isn't good with that. So, we try to mitigate that downside risk as much as we can. Can we eliminate it entirely? Not so much. And again, if you eliminate volatility entirely, you also don't make gains on the upside. So there's a give and take for every action that you make, but it's important just to mitigate the risk as to the point to where you're comfortable in allowing your strategy to work over time. So good question. We appreciate it. Let's talk a little bit here about GDP, Mike. Tomorrow is the big GDP report.
I believe it's today.
Oh, I'm sorry. It is today. You're right. It is today.
In less than an hour.
Second best day of the week. GDP is expected to come in a whopper number. Latest estimates from the Atlanta Fed, which does a real-time tracking of economic data, suggesting that we could see a 37% increase in GDP for the third quarter. That's amazing. That's going to be a historic record-smashing quarter for GDP. That's the good news. Now, what's the bad news?
The good news is you started at the poker table with $100. The bad news is you lost $50 back in March. The good news is you made back $40 today at 8:30. The bad news is you're down $10 still.
Yeah,
that's the problem. Is that percentages aren't even. If you're, if you start with $100 and you lose 50% and you make 50%, you're not back to $100.
Right.
You're still short. And yes, the recovery has been strong. And when you say 30-something% up or down, that's annualized too.
Right.
Right. That's not happening on a quarterly basis.
Right.
So what Lance and I are, so we're still going to be down. This economy from where we started to now will still be down 4 or 5%, depending on where the number comes. And if you go back and look at the 2008 recession, for instance, it's still lower than where it was at the trough of that recession. Mm-hmm. So, yes, things are getting better. They're improving, but the pace of recovery is slowing down now, and we're still well below where we were. So, as you look at the number, you gotta think about it in context to where we are, how we're growing in the future, but also what happened in the last 2 quarters.
Right. And again, this is really key going forward too, because we've been, I was kind of poking fun yesterday at Wall Street Journal because they came out with a graph showing the economic recovery won't get back to the previous trend of growth that we had before. And this is the same, and their chart looks identical to the chart that we produced back in April and May when we were talking about the fact that when we recover economically from the shutdown, we will be at a lower rate of growth on an average trend line basis than we were even coming out of the 2008 financial crisis. And this is because of the debts and the deficits and what we're doing to the economy, et cetera. So we're going to have an economic recovery. There was never any doubt we would have an economic recovery. The question is really what will the strength, duration, and stability of that recovery be?
Right. And you're going to walk away from that poker table maybe with $98 now. So everyone's going to say it's recovered. The economy is back. We're back to growing at 1.5%, 2%. But you're starting with $98 instead of $100. So, today we're going to get a positive print and they're going to say we're out of a recession, right? Mm-hmm. We had our 2 periods of negative growth. That defines a recession. And now that we have positive growth, they're going to say we're out of a recession, but we're not. We're still below where we were. And when you ask me what a recession is, it's over once we get back to where we were.
Right.
And that, the scary part is I've been seeing some estimates, Lance, that if we don't get stimulus, Q4 GDP could be a negative number.
Right.
So this may be, we think it will be a long time before we fully recover back to where we were because, like you said, the rate of growth going forward has now been reduced even further from where it was.
Right.
And that was at a low level and reduced further from where that was from the recession before that.
Yeah, and we're actually never going to get back to where we were pre-pandemic. We'll get back to a growth level where we're growing at 2.5%. We'll say, oh, now we're back. But the level of growth will be lower than where we were previously. And that's just because of, again, going back to these percentages that we're talking about here. When you recover from a 50% decline and you get 50% of it back, you're not back to even, but we'll start growing at 2.5%, or more likely 1.5 to 1.75%. And we'll say, hey, the economy's back. Isn't it great? Look, we've got unemployment back down to 5%, but we'll have an employment to population ratio that is even lower than where it was previously to the pandemic. And so really you have to start to ask the question is, are we really back? And at what point do we actually start to realize the damage we're doing through the debts and the deficits?
Right. And a nice way to think about this, a friend yesterday said this is a pull forward recovery. Yep. So what we've done is we've pulled forward consumption from tomorrow to today. And that's great because our economic activity increases today. But tomorrow, you buy the house today, you don't have to buy it tomorrow. You don't have to buy the car tomorrow. Yep. So when we get to tomorrow, we got a new issue to deal with.
When we come back from the break, Mike and I are going to talk a little bit about, really what have we done to our voting system a bit by allowing corporations to participate. We'll talk about that after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
The show this morning at 6:47. Mike and I wanted to just pick up on. Mike and I were having this conversation yesterday. I was listening to kind of some of the Senate testimony yesterday on kind of the censorship issues by Twitter and Facebook and these other things, social media channels, which are potentially. And look, we're not casting any statements here, but the accusations is that they're censoring. One side of the conversation, right? And these are supposed to be platforms for free speech, right? So is there a question, and again, not making any statements, but the question is are they potentially influencing the election through their actions? But there's another way that corporations influence government action and government outcomes. And over the last couple of weeks, we've written a couple of articles talking about, no matter who wins really in Congress and who wins Senate and who wins the presidency, really ultimately we all lose because of the influence of corporations into the not only the election process through campaign donations, etc., but also through the lobbying of government and how bills are written. And so one of the questions that Mike and I were discussing yesterday is, when the founding fathers wrote the Constitution and established, and by the way, this is a critically important point if you don't understand this. We are not a democracy. We are a constitutional republic. And that's a vastly different issue. Those two things are vastly different. People think we're a democracy. We're not. But when the founding fathers created the constitutional republic, they empowered the individual to vote for their elected officials. Now, nowhere in the Constitution does it say corporations get to vote for their elected officials, but they do vote in a way by providing massive amounts of financial support. And then, of course, the problem is when they do that, somebody owes somebody a favor. So Mike and I were having this conversation. Mike, let me throw it to you for a second. What's your opinion here?
So last week we kicked off the Lance and Mike for President campaign, right?
That's right.
And we forgot to tell the listeners about the biggest bedrock of our platform. Right? That we will not accept a dime of corporate money. Right? Because when we are president, which, Lance, you got to come to D.C. in January for the inauguration.
I know, right?
You can stay here. We got a bedroom for you. So, when we become president and vice president come late January, we do not want corporations telling us what to do. We want to do what's best for the people. At times that will be great for corporations. At other times it may not be good for corporations. But we are elected by the people for the people, not by the people for the corporations. And that's it's important to have healthy corporations and to provide a business environment that allows them to operate, regulations. There's all kinds of issues. But when, if you, and I've been a part of this, I know how bills are written. They're written by literally a corporation will say, okay, we need a bill to pass through Congress that does A, B, and C. And the congressman will say, okay, I'll put that forward. I think that's good. Can you write it for me? And a corporation will literally write the bill. The congressman will probably edit it in some way. That bill goes in front of Congress. They vote it. Next thing you know, that some political person working for a corporation is really the one that wrote the bill. Mm-hmm. And we keep talking about what's going on in America and the fraying economically of America. And this is one of the reasons is that corporations have garnered so much power and so much of the wealth, and they've stripped it from labor, essentially.
Right.
And labor is me and you.
Yeah, exactly. When we had Congressman Kevin Brady on our show back in 2017 when we were talking about passing the new tax cut reform bill, right? So we were talking about passing tax cuts, and as I was talking to him, I said, hey, one thing we need to do here is to make sure that we cut spending. And during that whole process, very quietly in the background, a bill was passed that allowed corporations to contribute 10 times more to political campaigns than they were previously. And again, this is just the whole problem is that now we've got so much going into political campaigns in terms of corporate donations. They go through, they create super PACs, they create lobbies, et cetera. And all this money flows to Washington. And again, when somebody's contributing that much to a campaign, there's a favor owed down the road. Hey, I got you elected, so you now owe me a favor. And this is one of the big problems with the financial markets, and one of the big problems with the banking system is that, they're major contributors to campaigns. And this is why when bills are written like Sarbanes-Oxley or, the Frank Dodd bill, then all of a sudden there's a lot of lobbying effort that goes into to repeal and to replace a lot of those laws that make things more lenient on the people that they're supposed to be regulated. We never see, and during the financial crisis, no banker ever went to jail. No nothing ever happened to any of the Wall Street people that were involved in billions upon billions of dollars of outright fraud. Nobody went to jail. The SEC overlooks a whole lot of that. There's literally a swinging door between the SEC and Wall Street firms. So there's a lack of regulation and oversight of the most important part of our financial system, which continually erodes the financial foundations of the American economy.
Right. And lessons learned and bills passed because of lessons learned, like what we saw after '08, are slowly stripped of their value. Right. And this was true Glass-Steagall back in the 30s. They basically prohibited banks from trading and owning stocks and other assets because they were manipulating and they were a partial cause of the market. They also outlawed stock buybacks for the same reason. And of course, today they're all doing that stuff. And of course, today we have a similar type setup as far as stock market valuations go in bubbles.
Yeah, isn't it interesting that between the 1940s, when Glass-Steagall and stock buybacks were repealed, and and we put all these regulations in place post the Great Depression and post the 1929 crash, the markets didn't have any major crashes from 1940 to 2000. Yeah, we had a few corrections, right? But we didn't have financial systemic crises. And then since 1999, when Bill Clinton repealed Glass-Steagall and we allowed stock buybacks to begin again, we've now had the dot-com crash, we've had the financial crisis, we've had the recent crisis, and then there's more to come, right? And it's because of all these distortions to the financial markets that we've now allowed to creep back in because we have forgotten the lessons that we learned after 1929.
Right. And those bills are all bills that help corporations.
Right.
They really don't do anything for the people. Right. If this was all the people deciding what to do, what's best for the citizens, none of them would vote for this stuff to bring this stuff back.
Right.
Right.
Yeah, exactly.
It's sad. So, Lance, you always talk about this, that politicians on their suits should look like the race car driver suits, and it should, a big STP thing here and a JP Morgan patch there. And
right.
We should at least, right, at least let's know who bought them and who they owe to.
Right.
When we talk about who we're going to vote for, we should look at their top 5 donors, and that should help. That should really be what helps us decide what we're going to do, because they can say they're Republican, Democratic, leaning this way, leaning that way. But at the end of the day, if they got that JP Morgan sticker and a Procter & Gamble sticker and a Coca-Cola sticker, we know who they're going to benefit.
Right. And that's really, and unfortunately, that's really the case. And, there's, a better way to do this is and again, nobody wants to do this, obviously, and particularly if you're a politician who, when you get into Washington and you're, in that position, you live a very extravagant lifestyle. I mean, you are wined and dined and catered to, and, gifts are given and, favors are given. You have a very luxurious lifestyle as a congressman, a senator, et cetera. And, and because of what goes on, in reality, the average citizen should be allowed to donate to a campaign up to a certain level, say $50. And that's it. That's the only person that should be allowed to contribute to a campaign. And that should be limited. And you should only be allowed to contribute to a campaign that's in your state, the state of your residence, where you live. Where if my state of residency is Texas, I can only contribute to the campaigns in the state of Texas. I can't contribute to campaigns in Washington. Right now, we see hundreds of millions of dollars flowing into states that are coming in from all other states around the country to try to affect. And this is the important part. The reason that's going is they're trying to impact and affect the outcome of that election through advertising and spending. And that's not the way the system was designed to work. But that's also why we have the problems in our system that we have today.
Right. The Senate is very close to being 50-50, right? It could swing either way this election. So these corporations understand that they can throw a ton of money into a race in like Iowa and greatly affect that election beyond how the people are going to vote. And that's scary, because the people of Iowa should be able to vote for their senators, and their vote should be what matters. But they're going to persuade and allow one candidate over the other to thrive and possibly win that election because they want the Senate tilted in their direction.
Well, let me ask you one more question as we get ready to wrap up. I mean, out of 330 million people in the country, really, these two guys are the best choices we have out of 330 million people. The problem is that with the way the donation system works, et cetera, the Mike and Lance, ticket can't get any traction because we don't have any sponsorship to go run ads, and we don't have the money to go and compete, with these hundreds and billions of dollars worth of money that go into these major campaigns. That's why we can never get an independent elected. You don't know who they are. And they'll never have the opportunity to fairly and equally compete on the platform to actually provide us real choice as to who we want to lead the country and who might actually have the best idea for the best policies that would benefit the entirety of the country. Mike, quick close.
Vote for Lance and Mike, and we'll make sure you get to one of the inauguration balls. That's what we have. That's what we can tempt you with.
Exactly.
And you can stay with Lance in my basement.
There you go. Hey, and by the way, don't waste your vote on us. Make sure you do vote. Tuesday is the day.
Vote.
Make sure you
Please
get out
vote.
and vote and do what's right for the country. Hey, we'll be back tomorrow morning for more of the Real Investment Show. I'm your host, Lance Roberts. Get by the website, realinvestmentadvice.com. Get our latest comments, articles, etc. Mike's article on the Hunt brothers is out right now. Send your questions, comments as well. realinvestmentadvice.com. Have a great day. Stick around, though. Chris Salcedo's coming right up.
It's a rich man's world. It's a rich man's world.